Good afternoon, everyone. Welcome to our webinar. Come on in and get settled. We'll give everybody a minute to take their seats and get all set up before we kick off. Good afternoon, everybody. We've just got a few more people to join us, so we'll just give another 30 seconds or so and then we'll kick off. All right, good afternoon, everybody. Welcome to this month's webinar on Australian property, looking beyond the headlines. We're looking forward to a robust, detailed conversation on a very popular topic. This is our 5th monthly webinar since we first kicked off when we all went into lockdown earlier in the year. For those of you who are joining us for the first time, just wanted to let you know you will receive a copy of the recording in our newsletter this afternoon. And it'll be posted live on our newsletter next week, and it'll be posted live on our events page this afternoon, so you can go and have a look there if you missed some of the hot conversation. If you're not currently subscribed to our newsletter, I do encourage you to do so. You're missing out if you're not already getting it. So go to our webpage down the bottom of our webpage, which is just evalesco.com.au. You'll be able to subscribe to the newsletter where you can keep up to date with upcoming events and what's happening within the Evalesco community, as well as interesting and informative topics. Next month's webinar, we'll be talking about sustainable and ethical investing, which is a very popular topic at the moment. So if you're interested in that one, which I'm sure many of you will be, please do look out for the invitations and the timing for that as well. Just, sorry, getting myself organised here. We'd also love to hear any feedback that you have on other topics that you would like us to cover in future webinars. We're really keen to make sure that the content that we're providing is relevant and timely and informative. So if you do have some ideas about what you would like to hear more of, or what you think other people would like to hear more of, please let us know, and we'd love to speak about those. So before we get into the detail, just the usual general advice disclaimer. So even though many of you on this call are clients of Evalesco, what we're going to talk about today doesn't take into account your own personal circumstances or situations, so it should not be taken as personal advice. Of course, if you'd like to discuss anything in more detail or anything of interest, please get in touch with your advisor or myself, and we can put you in touch with the relevant people to talk to about that. As attendees of today's webinar, you're on mute during the webinar and we can't see you, so feel free to chat amongst yourselves if you're there with somebody else and move around. We do encourage you though to ask questions on the way through. Questions will be answered where possible throughout the presentation, and so you can see on the screen now, if you just go down to where it says Q&A at the bottom of your screen and click on that, you can type in questions that you would like us to answer along the way. So we'll do our best to answer those as we go through, or perhaps get back to them at the end, and if we run out of time, we can come back to you after the webinar as well. And we've already got a few questions popping through. So that's great. Thank you for those people who are already posting questions, and we'll get onto those shortly. We are going to try something a little bit different today as well, and we're going to have a couple of poll questions for you. So I'm going to post a poll right now to get started, get a bit of interaction, and set the scene. So I'm going to relaunch the poll. So hopefully on the screen there, you can see some questions in relation to how many properties do you currently own? So if I'll give you a couple of minutes to answer that, that's great. You can see the answers coming in. And the reason this is relevant is just to give us a bit of an idea. There's a lot we can talk about in the sphere of property. And John, who's about to join us, is a wealth of knowledge. So we can use this to help us to focus the areas that we might talk about and what may be the most relevant. So we've got quite a range of people. We've got some people with no properties, a number of people with their own owner-occupied home only, a couple with one property, and a few people also with more than one investment property, which is great. So I'll just give you one more minute to put the answers in there. One more minute to put the answers in there, and then I'll introduce you to our guest for the day. So that's great. Very interesting. Quite a diverse range of property experience on the line, which is fantastic. So as I mentioned today, we're going to be talking in detail about Australia's love of residential property, particularly in Sydney. It's always a hot topic of conversation, and we're going to dig a little bit deeper than the headlines that we'd normally see today and look at what's happening in the diverse property markets around Australia, where there might be some opportunities, and what are the tips and traps for investing in property in the current environment. Really excited to be joined by John Pidgeon. A bit of detail about John there, but John's, by way of background, John's a proud property expert. He's got many years of advising and assisting people to secure quality property to help them achieve their goals. And John's philosophy is very aligned with ours here at Evalesco in the way he approaches helping his clients. He's also the co-host of My Millennial Money, which is Australia's #1 finance podcast. So he's very familiar with this type of medium and format. And unfortunately, John, I don't think I'll be able to match the level of banter or comedy that Glenn usually brings on to these types of things, but I'm sure we'll have an interesting conversation. So thanks for joining us, John.
Yeah, thank you, Jeff. And massive apologies. I was running one of those podcasts and it ran over time because Glenn was talking too much as normal. So yeah, but we actually interviewed the chief economist at Sun Super, which was a fantastic experience. So I've got hot off the press intel on his visions or estimations as what the property markets are going to be doing going forward, which was awesome.
Excellent.
Yes,
nice and timely for our clients.
Absolutely. Yeah, I'm sure there's a lot of fear and uncertainty out there for a lot of people at the moment through these uncertain times.
That's right. So maybe to get us started, John, we've got obviously a few things we're going to drill in on. Maybe tell us a little bit about why are you so passionate about property?
Yeah, so a quick backstory. I grew up on a farm in country Victoria, so loved land, loved acreage, and I always, for some reason, had a passion for property. I think when people look at property or shares, it's usually one or the other. Sometimes later in life, a combination of both, but usually they understand one or the other. And for me, it was definitely property, maybe from living on the farm. So I started investing when I was 21, straight out of university. Property markets were a little bit cheaper back then, but had some pretty good results early on through no result of my expertise. It was just simply luck. So I just, I was always keen on the ability to leverage money. So my uncle was a banker And he taught me early on that the people that were making the most money were either business owners or people that were actively investing in either the property or share market. So understand one of those and run with it. So that's essentially what I've done for the last 20 years. In the last 10 years, I've started to coach people on the principles of what I've built mine on. Not saying that I'm the expert and know everything, but I did make a lot of mistakes early. So being able to coach people on that is always helpful. I've always had that coaching education background as a teacher. Yeah, I love helping people in general.
Fantastic. That's great. It's always good if you can learn from other people's mistakes rather than making them yourself, isn't it? So
Totally.
All right, so jumping into, I guess, what's happening in Australian property markets at the moment from your perspective, and also maybe some of the hot off the press intel from Sun Super.
Yeah, well, thankfully Brian and I were on the same page today, which was great, and in the sense that we firstly need to recognise that there are many property markets around the country. So I'm sure a lot of your listeners are Sydney based. But even within Sydney, there are multiple property markets and multiple property types. So we've, generally speaking, property, we've got apartments and we've got houses. So they are two very different beasts at the moment. I'm seeing in Sydney some oversupply of apartments in some areas. And you only need to look at the vacancy rates to be able to see just how bad that is for some areas. Again, there's an article in the Australian Financial Review today which suggests that over the next 2 or 3 years, construction on apartments is going to dive considerably, and in Brisbane up to 90%. So the amount of dwellings coming out of the ground is going to be severely reduced. But I think the demand is also going to be reduced somewhat because of the lack of immigration and even the lack of interstate migration, although you might argue that you want to get out of Victoria at the moment, but you physically can't. I think if we broaden outside of, if we stay in Sydney for a moment, I think the housing market really hasn't missed the beat, in generally speaking, and I don't see that will change in the few years preceding us. I think interest rates aren't going to go anywhere, is my assessment. So it's relatively cheap money. As I said, I've been investing for 20 years and without a doubt, it's the cheapest money I've ever borrowed. And because of this COVID environment, I don't think the economy is in a position where interest rates can take an increase. If we spread out from Sydney, generally the migration has been to southeast Queensland. So the Sunshine Coast, Gold Coast and Brisbane markets have performed pretty strongly in the last few years. I think that will continue. Again, housing very different from apartments, but yeah, generally speaking in the housing market, that's remaining to be strong. What COVID has presented, however, is I think a massive opportunity for people wanting maybe a lifestyle change, knowing that, and you probably attest to this, Jeff, how many is now sitting in offices that were sitting in offices 12 months ago, very different. So can they now work from Wollongong, Newcastle, Central Coast and do their job maybe even more efficiently than they have done? I think COVID has taught us that. So what that does is opens it up to a lot of regional locations that are within earshot of an airport, or indeed coming into Sydney or Melbourne or Brisbane once or twice a week or once or twice a fortnight. Very different from the daily grind of jumping in the traffic for 2 hours a day.
Yeah, it's a really interesting one. There was already a question posed about that, and Central Coast and Southern Highlands were mentioned in those questions, and I think it is something that a lot of people are thinking about, and certainly a few of our clients. I know a couple of my clients have already made that change over the last few years, and I think it's, as you said, more topical at the moment. What do you see? I mean, have you seen any evidence of that starting yet, or is it still kind of talk, and where do you think that's going to go?
Yeah, without pulling the complete rabbit out of the hat, we've been investing in a few of those regional locations for the last 2 years, and definitely the last 6 months, the growth has started to come. The days on market are reducing, vacancy rates are under 1%. Now, in the case of Newcastle, Wollongong, and Central Coast, I think what we saw was the growth in the housing markets in general in those areas have been pretty substantial from about 2013, 14 through to 17. So they've already had double-digit growth, and usually what happens in a lot of property cycles, and I think we've got a slide that we might put up in a moment, but what usually happens after that is some sort of readjustment or flattening because of what's occurred in the last 12 months to 2 years, where interest rates have remained low. The economy was reasonably in a pretty good position. I think that hasn't really happened in those markets. So, but because of this maybe sea change or lifestyle change, it may recover, if you want to call it that, into some continued growth going forward.
Okay. So I'll just put up that property clock slide now, which I guess is a little bit about what you're talking about there. So I don't know, would you like to talk a little bit?
Yeah. So I'll expand on that. So generally, and I've got there Sydney 2013-14, what happened to the housing market in that time? Well, if we had a crystal ball and we did our research well, we would have said at that time, 2008 to 2013, generally speaking, in a lot of Sydney suburbs, it was experiencing flat to no growth. From 2013 to 14 onwards, however, was when the markets really took off, and there was that double-digit growth consistently for 2 or 3 years, some areas more so than others. So it was that perfect storm of the yields were quite high back then, and we went to Western Sydney personally and got a 6% gross yield and bought something for 250 grand, right? Fast forward 3 or 4 years, the yields were back down to 4% or less, but the property price had essentially doubled. So knowing that every property market has a cycle, and it's just identifying where that particular market is on that cycle, and not reading the front page of a newspaper and saying the property market's boomed or the property market's rubbish, because there are so many individual property markets around the country. So when you're buying as an investor, we want to be looking at, go back a step, there's 3 ways to make money in property: buy at discount, add some value to the property, and capital growth. Now, the last one, capital growth, is the biggest one out of those 3 out of our control. So we want to focus on the first 2, but the third one makes us the most money. To take something from 250 and turn it into 500,000 in 5 years is a pretty good outcome that you wouldn't have been able to get through discount or add value. So in order to maximize that capital growth, we look at that cycle and say, well, where has it come from historically? And economists are really good at this, is looking at historically, what's it done in the last 10 to 12 years? Forecasting going forward, where is it sitting? Has it already had double-digit growth? Is it going to continue? Because most growth cycles are only 3 to 4 years in length, usually. And when I say usually, this is where this COVID situation's come in to maybe throw the rule book out the window a little bit in respect to a few of those locations closer to those major centres. So where do I want to buy on this property clock? Makes sense that we're probably 6 to 7 o'clock. Where do most people buy on the clock? Usually when the auction clearance rates are up and there's 30 people on an open home and I got outbid on 2 auctions in a row, it's 11 or 12 o'clock market, and that's generally when I buy. There's that fear of missing out. There's that emotion-driven purchase. So understanding that where most people buy and where you actually want to are at opposite ends of the spectrum, which is, I think, Warren Buffett's principle of when people show fear, I show courage. When I show courage, people show fear.
Yeah. So how do you, I mean, I think that makes sense. And when you put it up in a model like that and talk through it, it seems pretty logical. But, you know, the reason that most people do it the wrong way is because we're not all logical. How do you sort of counter the view that, you know, particularly in a market like Sydney, which has had pretty consistent growth, and you can sit there and, you know, look at what was the property price in 1990 compared to what it is now, and, you know, those types of things. It almost is that fear of missing out, but the thought process that, you know, if you buy a place in Sydney in the right location, it's always going to go up in value.
Yes, it is. I suppose
that is the case, but that's, you know, that's a popular view.
Yeah. No, well, look, historically, you're right. If you look at something that anyone bought in 1970 to now, 50 years later, it's obviously increased in value, and that's why people like to see property as a safe option. But property is also a boring option. You're not checking the value of it every day. You're not transacting every 6 months, or most people aren't anyway. But as investors, if we're not just buying our own home and then putting the queue in the rack, we're always looking at maximizing our output, no different to any of the stuff that you do, Jeff. So we want to take the conservative approach or the low risk approach, but we want to identify how can we maximize our returns early on, so that if we do buy at an opportune time in the market, can we get that upside in the first 12 months to 2 years that actually gives us the ability to leverage out of that into a new property or a new investment, as opposed to buying at the wrong time, which could actually mean that we're holding on 5 years, 6 years before we can get that equity out. So straight away, we're maybe 3 or 4 years in front of most other pundits. That's probably what we're talking about there. But yeah, generally speaking, it's a boring old philosophy, but it comes back to how aggressively you want to grow your portfolio. It's not necessarily the number of properties. We talk about what the properties are actually doing for you. And in a business owner example, it's your properties are like employees. They're either giving you cash flow or they're giving you growth. If they're not giving you either, you need to sack them.
Yep, makes sense. So what do you see in your process and your philosophy as the key drivers and the key things that go into, you know, working out where and when and what makes a good property and how to get the maximum out of it?
Yeah, so we look at the top 30 cities and towns by population around the country. So Sydney and Melbourne are 1, 2 of those, and number 30 still gives us about a population of 100,000 people or a bit less. So they're towns and cities that are definitely self-sustainable on their own. They're not one-horse-driven mining towns. The population of those areas are increasing, not decreasing. So we look at the macro indicators of population, infrastructure, and economy, those 3 things, and looking then at the micro indicators within that to see, right, what suburbs are going to be more appealing as an investor than others. Is it what is our schools like? What's the public transport like? What's the parks and gardens like? What sort of infrastructure changes are potentially coming? So we're very macro focused to begin with, to then delve down on micro indicators. But from a numbers point of view, and I'm more of a numbers person than anyone, and combine that with logic, if we've got a vacancy rate, I think a standard normalized vacancy rate is about 2% for property around the country. If we're underneath that, and there's a couple of locations that we're investing at the moment that are sub 1%, like the property's vacant for half a week a year, which is absolutely crazy. Yeah. But the yield is 5%. So we know that the last 4 or 5 years in that area, that there's been some growth, but the rents improvements have been aligned to the property growth. So Is
Just
it
on that,
cheaper to,
what's the sort of average or expectation you would have long term on yield? So 5% you're saying is a bit high by the sound of it. So what would the sort of long term expectation be?
yeah, well, to give you a few examples, like if you were to buy something in Bondi right now, you'd probably be getting about a 2.5 to 3% gross yield. So 5% is pretty strong. It's what we call dollar per thousand. So you buy something for $500,000, it'll rent out for $500 per week. So I think I had an aim 20 years ago to have my portfolio averaging at about a 6% gross yield, meaning that if I lost my job, if I factored in a couple of weeks of vacancy across my whole portfolio, that my portfolio would look after itself regardless of what I was doing with my work based on a 6% yield. So you're not going to get that very rarely straight up, but you can build your portfolio to get an average on that of 5 to 6%, I think.
Okay. And do you see, in that context, is there normally a direct trade-off between yield and capital growth, or how does that sort of play out?
Yeah, as I was explaining, I'm thinking Jeff's going to ask me that one next. So yeah, definitely is. So I think if you're sticking to those, well, my personal view is, and this is no individual property advice by any means, but if you're looking at the top 30 cities where they're reliable, their macro indicators are stable, you're going to get some growth at some stage and your yields are going to be pretty solid. It's when you get to that 50th, 60th, 70th population town where we can go and search. Like I looked at a property last week for a person out of interest that said, yeah, check this out, John. It was a property for $150,000. It was renting for $230 a week, which is about a 9 to 10% yield, right? So cash flow was giving you about 8 or 9 grand a year. If that's your strategy, then knock yourself out and go and do that. It's not in the top 30 cities by population, but it's giving you 8 or 9K. Is that value going to go from 130 to $500,000 in the next 10 years? It'd make a mug of me if I said yes. So I think it really comes back to what is your strategy? What do you need in your portfolio? Because if you've got a highly negatively geared first property, you probably want to get a more of a positive cash flow second property. So it's getting that balance, I believe, because if something hits the fan and you're left without a job, or there's something happens in your family or your life that means you can't work, you don't want to have to go and sell your portfolio. That's where I think a lot of investors get it wrong, because they're either buying at the wrong time or they're shooting for the stars without a rocket ship.
Yeah, no, that makes sense. So when you're looking at those regional areas, and you talked about, looking at what's happening infrastructure-wise, look at population, infrastructure, and economy. How far out do you look? And because you talked about, the opportunity to, if you can get some growth in that first couple of years, it sets you up really strongly. So how far are you looking at those types of areas before you start investing, or, how far do you want to see a few runs on the board or those types of things before you actually bite the bullet?
Yeah, good question. Risk profile is a big one in respect to that. You can take the build it and they shall come philosophy, where you may be getting in a little bit earlier. Like if I had identified a market to say, well, I think it's going to grow in the next 5 years, but it might take 5 years for it to grow, but I know I've bought in at the bottom of that market, it would have been Perth, right? Perth has been flattened with mining in the last, well, give it 7 or 8 years. Yep. And you can probably buy in, or 12 months ago, you could buy in less than the price that it peaked at in its previous cycle. So you know that it's going to recover past that peak at some stage. So are you going to get some growth out of that in the first 12 months, 2 years, 3 years? Probably not. If you get it, then it's a bonus, but you know that you've paid bottom dollar for it on the way in. So if that's the build it and they shall come strategy, but if you're looking for growth in the shorter term, I think you really need to see signs of it having already grown or had some sign of recovery with momentum already there. So your days on market have already reduced. The clearance rates are up if it's an auction-driven city, etc.
Okay, so that's where you're referring back to the property clock. You're sort of saying Perth is possibly, at 4 or 5 o'clock, or maybe getting to 6, but you're not quite sure. It's somewhere in that range. Whereas if you see something which is at 6 or 7 o'clock, you can feel a bit more confident that may be short-term upside.
100%, yeah, correct. And no disrespect to Heron Todd White, the largest valuers in the country, but they produce a monthly property clock, and they have different towns and cities listed on that clock every month. Now, call it marketing, call it fluff, whatever. Those towns are changing from 3 o'clock to 5 o'clock within the space of 2 or 3 months. I just don't think that happens that quickly.
Yeah.
Right? It can't. As I said before, from a recovery growth phase through to a hot market is probably usually a 3 to 4 year period on looking back historically. And so to say that something's gone from 9 o'clock to 12 o'clock in 2 months is probably overinflating it a bit, or they got it wrong when they initially estimated. So yeah, as I said, it's a boring old game because it does take time.
Yeah. Okay. So we've talked about, I guess, potentially some of the opportunities which might be coming out of the current situation in COVID and that, I guess, tree change or sea change type mentality. What do you think are some of the traps that people should be aware of that may be specific to the environment or just in general as to where we're at, particularly in New South Wales and Sydney based?
Well, I think it's always been a personal trap, and this is why we started the podcast. The personal trap is our own cash flow management system and not having our buffers in our life. So having those 2 or 3 months worth of cost to exist sitting there in your bank account, never to touch, only to use for unforeseen circumstances, not to buy a new car. Having your goals and your long-term strategy in mind. And then particularly when looking at markets, the cute thing to do for a lot of people is to go and buy a lifestyle block or a holiday destination block, right, with an old shack on it, with the vision to go and visit it or maybe live there eventually. But it's only a town of 4,000 or 5,000 people. That's okay. Just don't put any pressure on it to grow considerably in the next 5 years, right? So that's a very different play from the actual lifestyle change or sea change where we're saying, right, we're going to live in a good solid area that's got more of a backyard or it's got more of a relaxed lifestyle. And at the same time, I'm identifying, maximizing my potential of that property in the next 2 to 3 years. So, because I think 80% of homes around the country are owner-occupier homes. You would argue that majority of those that buy them are not looking at any of this stuff. They're just simply buying for the sake of it. And our data comes from those sort of people. So who's going to be emotionally invested in this particular area? And we can follow that as an investor.
Okay. So that's obviously where the current opportunity lies with those people who are emotionally invested with escaping the city and escaping the virus and heading to those regional areas and that sort of thing, which is the opportunity.
Yeah, and so yeah, you're talking about two different beasts. You're talking about the owner-occupier that wants to move. And you're talking about the investor that wants to go and invest in those areas where those owner-occupiers are going to move to, which is, I think, what's happening now. And I think only more of it will happen, knowing that, as I said before, they can work from home or they don't need to be anywhere at a particular time. And And we're on this call now. I don't know where everyone else is around the country. Most of them, I presume, in Sydney, but it's become the norm because it's been forced upon us. Like, we could have done this 2 years ago, but we didn't, because our mindset was we need to be in person. We're going to get more productivity and efficiency out of everyone.
Yeah. Okay. So you mentioned a couple of those areas, including southeast Queensland and the regional areas around Sydney, Wollongong, Newcastle, Central Coast, those types of things. Are there any other, and we put the disclaimer up early, this is general advice and not personal advice. So are there any other areas that you think you're seeing where that's happening that we might not be as familiar with, given that we're in Sydney? And I guess the second part of that would be, also you mentioned about the difference between houses and apartments or units. So I wouldn't mind you touching on that at some stage as well.
Yeah, sure. So looking at those three largest cities, Brisbane, Melbourne and Sydney, and looking at what's an hour to 2 hours from those locations. So we've touched upon southeast Queensland, we've touched upon the New South Wales equivalent. The Victorian equivalent is your Ballarat, your Geelongs, your Bendigos. So all 100,000 people, give or take, plus, all with population growth estimates that are solid, all with pretty good yields, and their markets, the vacancy rates and the days on markets are already decreasing. So they're definitely markets that we're in and looking at really solidly. And I don't release that information too often, by the way, but I'm happy to give you an idea on the work that we do, is to know that we've been in those areas for 2 years. You don't necessarily want to be the pioneer of an area, but you also want to get in at a time that's going to work for you and your investors. So it's I think from an investment point of view, if I wasn't going to tell my brother or sister to go and buy there, then I wouldn't be going there. Mm-hmm. That's the general investing rule for me, but owner-occupier is a different story. To get back to your point, airports, access to the city, those sort of indicators are prime right now. We don't know when we can get back on a plane, but knowing in the future that will again become the norm, might be a new, different norm, but knowing that we're in a town big enough where we can get a job locally if we need to.
Okay.
Houses versus apartments.
Yeah.
So I've got both in my portfolio. Both have performed for me. You're using the same principles in respect to the supply and demand. You're using the same principle with the vacancy rates. The big issue, or not an issue, but an indicator, is apartments are essentially airspace, and at the drop of a hat, the council, the local council, can change their conditions to say, well, now we had a 5-story limitation, now we've got a 12-story limitation, right? You've essentially almost tripled the ability of apartment growth in that suburb alone. So that's where a lot of oversupply has come on in some of those city markets. Yeah. Whereas land, you might be able to chop it up into 2 or 3 blocks as a maximum, but essentially there is a definite limitation on that for location. A side note to that is a lot more people are wanting to be front and center to all amenities. So that's where apartment works for a lot of people. If it's an owner-occupier, I've got my cafe downstairs, I've got the train station over the road, I've got my restaurants in the same street, my school's walking distance for the kids. It all works for me. The limitation, however, is I buy a 2-bedroom apartment, I get 1 car space, I can't have a boat, I can't have another car. If I have any more kids, we need to move out. So it's looking at, when you're buying and selling, who's going to rent it off you, and then who's going to buy it from you in 10, 12, 15 years time. If it's only a single person or a couple that can buy it off you, you may be limited in your sales exposure.
Sure. Okay, that's great. So we've got about 5 minutes to go. I've got a couple of questions that have been typed in here, so I might hit you with those, and then we'll look to sort of wrap up.
Sure.
So we've got a question here about structures or the types of property that might be appropriate for helping children get into the property market, which is a pretty topical one for our clients. And living in Sydney, it's expensive and hard to get in. So have you got any experience or tips in that regard?
So when you say children, I presume 18 plus? No.
Yeah.
Yeah. So I think the big one is parental guarantor.
Mm-hmm.
That's quite a common one now for Sydney and Melbourne people, just simply because it's unaffordable for them to do it alone. So the bank takes security over the parent's house, and so that works, I think, quite well. Parent loans to the child also work well. I think that segregates it from having to be a guarantor over that property. That may be a better option. At the end of the day, you're vulnerable either way. You loan it to the child, or you put your house up as collateral. So they're probably the two most common ones. But depending on the age of the kids, I've got 3 kids, 7, 9, and 11, and teaching them the concept of money and the difference between discretional spending and saving, and what it can do for them, and just having those conversations on the table, and not having them grow up as money as a dirty word. And I'm sure your clients are all over that, but making sure that money is actually for good, not for evil, right? There's going to be greed and selfishness no matter where you go, but it's telling them that it's actually a good thing to have, provided that you do the right thing with it. To get someone into the market for the first time, rent vesting has become now potentially the new norm, and it's already been in London and New York for quite some time, where they know that the next generation will never live in their own home. They'll just potentially be just renting and buying assets and having no bad debt, and loading themselves up with investments, whether that be shares, super, property, etc.
Yeah, and that gives you the flexibility to live, rent where you want to live, and buy where you might think is a good investment opportunity as well.
Yeah, and that was my model for 15 years until kids came along, and we wanted to have a little bit more stability in that respect. So it was exactly that. I can choose as to where I want to live.
Yeah.
And I know I can get into, if I was a first-time property investor now living in Sydney, it's going to cost me the best part of 700,000 or 800,000 to get into anything decent. There's no way the next generation can afford a 20% deposit anytime soon. So the only other option is to have a parental guarantor, which puts the parents at risk, and the yields are going, or the repayments are going to be still quite high, which may impact someone's lifestyle. Mm-hmm. Or I go and buy somewhere else around the country for 400, 500,000. I've already invested my money, but it's in my view, a lot safer alternative.
Right. 2 minutes and 2 more questions, so I'll quickly try to get those on in. Some questions in relation to the sea change, tree change, and the different age groups. And do you see any impact of age on where people are buying or the types of property they're buying?
Yeah, usually when they're sea changing, they're not going to buy an apartment. They're going to get something bigger. They're going to get a house. They're going to have a good size block of land associated with that. Now, when I say good size, things are getting chopped up into 250, 300 metre lots these days. So a good size might be your 500 to 700 square lots. The age group is tending to be that I'm starting to have kids and the apartment's a bit tight or the unit's a bit tight for me now. If I upgrade to a home in this same area, it's going to cost me double or triple. I can't afford it. So I'm packing up and I'm getting out of this hustle and bustle lifestyle that I enjoyed, but now because of my situation, that's usually someone that's 30s to early 40s. The southeastern migration into Queensland is that, but it's also the retirees that think that Melbourne's too cold and I've got arthritis and I need to go to Queensland to warm up a little bit.
I think they're right. Melbourne is too cold.
Yeah, absolutely it is.
Okay, and one sort of follow on and last question, and if anyone needs to go, we'll excuse you for leaving as we go over time, a couple of minutes. I guess related, you kind of talked about the difference between buying an owner-occupied and investment property. Do you see, is it just a bad idea to try and combine the two? So, for example, buying a property which you think could be a reasonable investment now, but you might move into it later, or buying a property you're going to live in now, but you think might make a good investment property later. Can that be done? Should it be done?
Absolutely. Yeah, absolutely it can be done. I think the last 6 months has made that more attractive because of first homeowner concessions and home builder and things like that. So yeah, it definitely can be done. What I don't want to see is people transacting too often. So they buy something that they can afford and then in 2 years' time, they're selling out of that in the hope of upgrading to a better area. A lot of their money is chewed up with stamp duty and selling costs and those associated things from the transaction. So yeah, it definitely not a bad idea to buy a home for them to live in, maybe qualify for the first homeowner and then rent it out down the track to go and buy something else to live in. But I think where people go wrong, I was always told in property works, people don't. So people are the ones that make the mistakes, not the property.
That's a good note to wrap up the formal part of it. So thank you very much, John. Really appreciate it. Just seeing a couple more questions, but we're kind of out of time. So we'll come back to people who've asked a couple of questions late in the piece there. Sorry, we haven't got time to get to those. So thank you very much, John, for sharing your wisdom. Really appreciate it. We've got, on the next couple of slides, you've got some tools and some calculators and some places that we suggest people might go to get some more information and get in touch with you. So this is via your website. And that's probably the best place to get in touch. So as we said, this presentation will be available on our website this afternoon and come out in the newsletter next week. So if you want to go and have a look at some of John's resources and get in touch with John, that's the place to go.
Cool.
And you've also got some great education, the podcast as well, a weekly email, and then on the socials, track you down on the socials as well. And the final one is that you've got some programs that you run that you've kindly offered some discounts for our clients if they want to engage your services to help them to source a property in the buyer's agent space. If they want to increase their own education and ability to, I guess, drive their own property journey a little bit more, the Academy can help them in that regard. And then also a clarity call. So maybe just what's the clarity call? If you can touch on that.
Yeah, we get a lot of people inquire and say, well, I don't actually know what I want. So I've been thrashing this out with my partner or by myself, and I just don't know what my next step's going to be. Is it buy my own home? Is it buy an investment? Is it sell the property I've got? So we do one-off clarity calls that are usually about an hour, and that just overcomes the roadblocks and, as it says, gives people clarity on their next steps forward. It's just a third-party independent look at it, as opposed to being wrapped up in sometimes their emotional roller coaster in their own mind.
Fantastic. A lot of value in that for sure. That's great. All right. So if anyone would like to get more information from John or access some of those resources, the website will come through to us. We can steer you in the right direction as well. We'll talk to your advisor about how it fits into your overall plan, and then how we can get John involved to help us to make the next step on the property journey. So as I said, thanks very much, John. Really appreciate your insights and your willingness to share and give us a few of the inside secrets there that you don't normally give away. And thank you to everyone for listening and tuning in. The recording will be available this afternoon. If you subscribe to the website, it will also come out available via, if you subscribe to the newsletter, via the newsletter this time next week. And if you have any more questions, shoot them through and we'll get back to you. Otherwise, enjoy the rest of your day. Thanks very much.
Thanks, Jeff.
Thanks, John.